everyone. A very good afternoon. You're watching the newsroom on ET now. I'm Ubina Kapasi. What the markets are up to? Well, it's another day of being in the down low. We have the Nifty 50 that's 11,880, and the Sensex that's losing about 132 points at 40,575. Where exactly are we seeing momentum? Let's take a look first at the two-wheeler space. Hero MotoCorp, Eicher Motors, and now, of course, the latest stock in news is also Bajaj Auto, which delivered its second quarter numbers. Hero MotoCorp is down 3%, Eicher is down 1.4%. Comparatively, for Bajaj Auto, it's, sort of okay-ish. The revenues have come in at 7,155 crores. Margins are at 17.7%. Both of these are in line with expectations. And the profit after tax has come in at 1,138 crore rupees. Let's move on and talk about, of course, the pharma space. We have an ET Now exclusive. We have some other news on an Aurobindo Pharma as well. So let's take both of these one by one. First up, of course, Aurobindo Pharma. The news around this one is the fact that the company has received a warning letter. And while Auro, of course, says that, look, this is not going to impact their, their business as such, but you are going to see you are going to see some hiccups when it comes to future approvals for Aurobindo Pharma. And moving on, let's also talk about Dr. Reddy's. My colleague Ajay Sharma first reported about a data breach at some of its facilities, and this is something that does not bode well for Dr. Reddy's. Statement as well has been released by Dr. Reddy's, so watch out for that. And finally, JK Tyres. Quarterly results is something that is keeping the stock active. In fact, I think this is the biggest intraday move that we are witnessing in the tire company. This is the first of the big tire companies to release their Q2 numbers, and it's the biggest price momentum that we are witnessing in almost 18 weeks. So there you have it. Those are all the stocks in news and everything that you need to watch out for in trade. But markets otherwise, they are seeing like I said, it's the auto space really that's down in the low. That sector is among the big losers. IT as well is not doing very well in trade today. But on the flip side, you do have metals that are doing extremely well. Vedanta today is doing very well. It's a big rally being witnessed in this one. Tata Steel today is the top Nifty gainer. I think the last time I checked, it was up by almost 2 to 3%. So great momentum being witnessed over there. And yeah, since morning we've been flagging of how aluminium prices, copper prices, zinc prices have all been doing very well. Nickel too, in fact, has been doing extremely well. So that's, of course, about the momentum being witnessed in metal prices. Okay, well, meantime, Bajaj Finance delivered its second quarter numbers. Here's a small excerpt of the conference call that the company conducted post the numbers on what transpired in Q2 and what's the outlook.
From the month of September, the company has started to accelerate volumes across all businesses. We do expect even bureau data to go fully on stream by November, which should further add volume momentum. Please do realize that bureaus are the quote unquote the radar on which the consumer credit in any part of the world works. It is a headwind, and from an information availability standpoint. Let's talk September. September, clearly, let's break this into three parts. There are a set of consumption businesses that we are in. The urban consumption business came in year on year at 72% of monthly volumes. Rural is starting to be back virtually close to 100%, came in at 91% of year on year volumes. Credit card origination at 73%. E-com came in at 75%, and auto finance was at 54%. If you look at loan businesses, which is whether it's personal loans, mortgages, rural personal loans, SME, were at 60 on an aggregate basis at 62% of last year's volume. In the current quarter, company acquired 1.2 million new customers. Overall franchise stood at 44.11 million customers. Point number 7, AUM moderated to 1%. We talked about it. It's 137,000 crore. We expect now the AUM growth to be at 6 to 7% versus 9 to 11% that we're actually giving you in Q1. If the momentum by Q4 is stronger, which is possible, there may be a potential upside.
All right, well, let's move on now and talk about more earnings. Today we are expecting Asian Paints second quarter numbers, and there's expected to be quite a steady recovery that we are expecting in Asian Paints. A volume growth of 8% is what we are expecting. This after the company reported a 35% degrowth in volumes in Q1. Not just that, the top line growth is seen at 3%, but that's probably because, yes, there has been a growth, in the volumes, but on the pricing front, because of price cuts, because of discounts, there will be some drop in the realization, plus the mix as well is not that great, so that may restrict the top line growth to just 3%. However, crude prices, its derivative prices have been lower, so lower monomer prices, lower TiO2 prices are something that will also assist Asian Paints in its margins, which are seen expanding by close to 300 basis points. So expected to be quite a good quarter from Asian Paints this time around. I think the results should be out in a couple of hours from now. Well, moving on, after 4 bids were received for insolvent financial services company DHFL, ET now learns exclusively from sources that bankers are looking to negotiate to recover at least 40% of their total exposure. The current bid by Oaktree Capital offers about 30% of the current exposure. And we also learned that the Committee of Creditors will be meeting next on the 26th of October. Priyanka Iyer joins in with the details.
Well, yes, what we are picking up from sources at this point in time is that lenders to DHFL are in the process of negotiations with the bidders of DHFL. Remember, 4 bids were received for DHFL. One was Oaktree Capital, which was the only bid for the whole book of DHFL, and the amount we understand stands at 28,000 crores. It includes cash and NCD components. The other 3 bids are for the different parts, like Adani Enterprises has bid for the wholesale book. We understand the amount is at around 1800 crore rupees. SC Lowy has also bid for the wholesale book, but the bid amount is quite low and bankers are not really even looking at that bid at this point in time. The other bid that had come in was by Piramal Enterprises, and their bid amount is slightly over 14,000 crores, and they have bid for the retail book. So bankers are open to 2 options at this point in time, either to go ahead with Oaktree Capital and try to make them improve their bid amount, or go with a combination of Piramal and Adani. Wherever there is more recovery is what bankers are looking at. At this point, the highest recovery they're getting is slightly over 30% from the amount that Oaktree Capital is given. But bankers are hoping that they can negotiate for the bidders to increase the bid amounts, and they will recover over 40%. So that is the aim that bankers are going with, to recover over 40% of their exposure. So this is the entire situation right now, but definitely the bankers prefer to give the entire book to Oaktree. That is a bigger preference as compared to selling it in parts, selling DHFL in parts. The amount that DHFL owes to lenders and the claims that have been admitted by the RP stand at around 87,000 crore rupees. We also understand from sources that the COC will be meeting on 26th of October. There will be a few discussions on the negotiations that are happening, and post that, if any of the bidders are willing to submit a revised bid, then that deadline will be given as 31st of October to submit revised bids. So this is the timeline that we are looking at currently. The bankers hoping to get more than 40%. We'll have to wait and watch if any of these negotiations fructify and there are more higher bids coming in.
All right, Priyanka, thank you so much for that. With that, we'll take a very short break right here on the show. Welcome back. You're watching the newsroom on ET Now. Times Network's Special Investor Education Initiative, Nivesh Ke Funde, will seek to guide investors on better managing their financial portfolios and also provide them with simple explanations on how some financial products work. On this edition, we are looking at ETFs, or exchange-traded funds.
One investment avenue which has been gaining popularity over the last couple of years has been exchange-traded fund, or ETF.
That's true. Now, ETFs are funds that invest in a debt or equity index or commodities like gold.
Yeah, their expense ratio is low since they are passive investments, so they're available at a low cost to investors.
For example, an ETF that's based on a market index will invest in stocks of the companies in the same ratio as they're represented in the index.
So the performance of that ETF will rise and fall almost identically to the performance of that index.
To invest in ETFs, an investor will have to have a demat account, as they are bought and sold through the exchanges.
And this very aspect makes ETFs highly liquid, since they can be bought and sold like regular stocks at any given point of the day.
So do consider adding ETFs to your portfolio. That's all from us on this edition of Nivesh Ke Fande.
Amidst the renting versus buying conundrum, we caught up with PV Subramaniam and Prashant Thakur and tried to understand the renting price patterns, key trends as well in the realty space. Here's a slice of that conversation.
In a market which had a history of inflated rent, and now you're looking at a trend where people are willing to relocate to a peripheral area where they can afford a bigger house. And this trend is going to continue for almost 6 or 7 months. We don't know for how long, but there are certain jobs that definitely will continue to work from home. Let's say, the way this commercial space is also spanning out, that they're also planning to have these satellite offices, which could be near to the employees' accommodation. So this trend is definitely going to kind of take a greater momentum. And that's where people have realized people are now willing to kind of, experiment and move out to the peripheries. And in this high cost maintenance era, where I said that if I'm a landlord in Mumbai, and let's say my society charges a monthly maintenance of 10,000. If my flat remains vacant for 2 months, the rent escalation that I would charge and benefit gets wiped away. And I don't want to take any chance in this uncertain environment, and I would not like my flat to be vacant. So the tenants also understands this, the landlord also understands this. And I would agree to Mr. Subramaniam that, there are certain apartments in society which has, a good, which are in good localities, and then, the tenant might want to stick to them. So at max, what they are doing is that they're kind of approaching the landlord and saying, look, we cannot increase the rent. Let us stick with the old contract. And this is happening across the board.
Mr. Subramaniam, I go back to that very basic point, which is that should there be a benchmark of how residential yields they need to be calculated? I'm not walking the path of commercial because that's a separate calculation, that's a separate maths, that's a separate assumption. In tier 1 cities and tier 2 cities, is there a benchmark one should use to establish what is the fair rent? 10-15% premium, like you said, is a function of locality, society, friends, family, proximity to the garden, proximity to the office. I'm keeping that separate. But if one has to use a benchmark, is it 3% of the total cost of the property? Is it 4% of the total cost for the property? Is there a benchmark you would suggest?
I really don't know, because unlike equity prices and bond prices, which has got a fantastic price discovery mechanism, real estate does not have a price discovery mechanism. So in the same location, a Hiranandani flat, a Raheja flat, or a unknown builder flat, there is a 20-25% difference. So, and also rental yields in India make no money at all. There's no way how REITs in India will make money. So, right, if you're getting 2% or 3% in a country where 6% is the GSEC rate, I don't see any reason why rent should come down. In fact, I think the property prices should come down, and then these rents will look reasonable. So it's a huge demand and supply situation. And largely real estate buying is driven more by ego and societal needs rather than by commerce. So people just go and buy a place because there is pressure to buy a space. So I don't think demand and supply really works. And there is, like I said, there's no price discovery, right? Infosys has one price because there is a market quotation. Here there's no price discovery. So depending on your knowledge level, your ability to negotiate, whether it is a furnished flat, who is bearing the society charges, based on all this. So I don't know whether, because I see in Navi Mumbai rental yields of about 1% today. 1% doesn't make any money at all for the landlord. Why should he do this? So I don't think there can be a formula unless we have a fantastic price discovery mechanism of rent, which is possible because rental agreements are being registered today, and real estate deals. If everything is being captured very well and somebody like HDFC comes out with a rental index and a real estate price index, then we can put. With the base data missing, putting a formula makes no sense.
Moving on, the festive season combined with work from home has helped pepper fry reach the pre-COVID levels pretty quickly, says Kashyap Vadapalli, the CMO of Pepper Fry. Kashyap says and hopes that they can clock a 20% growth over the last year's numbers in this festive season. He adds that growth in volumes will be detrimental for the company to file for an IPO in the next 12 months. Listen in.
Because of work from home and study from home, interest in furniture for very specific types of furniture spiked tremendously. Whether it is, desks or chairs or even, bean bags and so on and so forth. Also, so when you combine these two trends with one kind of channel completely shut or largely shut and one type of product group getting a lot of push, when you look at these two things, there has been like a tremendous increase in interest in online. And that increase that we've seen has been across all cities. In fact, metros for us have responded, equally well as smaller, more underpenetrated cities. So this phenomenon in that sense is been more uniform for our category.
Okay, now can I ask you then, what's hot, trendy, selling this festive season? First up, would you say that this festive season your sales are what they were last year? Have they improved? Are they down? Are they the same? And then what are you seeing demand for?
Sure. So let me break that up. There is the festive season is, strictly speaking, the 30, 35, 40 days leading up to Diwali and the Diwali week. So that's one part of the festive season. When you look, the other way to think about festive season is, August 15th is festive. It's become almost festive for shopping as a category. Then again, the period between last week of December and Republic Day, that's also again festive. So typically, those are the three large festive periods, especially for our category. If I look at August, I think we were just coming out of the whole lockdown, in the sense that June is when our supply chain started kickstarting. Sometime in July is when our physical.
Okay, well, with that, we'll wrap it up on the show. Thanks for watching.